Hello, our viewers. Welcome to another educational video by Starlight Top Professionals. We are delighted to host you for another session where we are going to be discussing about bookkeeping and accounting. My name is Joseph Njehia. I'm going to be your host today, and we hope to offer you an insightful and enlightening session that is going to encourage you to keep complete and accurate records of accounts. Welcome.
Our agenda today is we're going to have a look at the background of bookkeeping and accounting and this detailed discussion of bookkeeping and accounting. So here's a background on bookkeeping. As we mentioned to the start of the video, we aim to equip or encourage business people, entrepreneurs, business managers in this session. And it's our passion and desire to see businesses are running with proper books of accounts. It's become a common practice in many SMEs and middle-size enterprises to have poor record keeping due to numerous challenges, which could be lack of the technical personnel or technical knowledge, or could be because of worst case scenario negligence. But it is important, as we are going to learn through this session, that maintaining proper book of accounts is a background of a successful business. Uh, accountants and accounting is very important to a business. Without this, the managers, the owners would be operating blindly, and therefore it is important to have, and most importantly is accurate books of accounts. So with that background, let us now continue. Bookkeeping is the practice of systematically recording, organizing, and analyzing financial transactions to help you track the performance of your business. By accurately tracking your business financials, you can make informed decisions that will help your business grow. Keeping accurate records also provides a reference point when filing taxes and helps you have an accurate picture of your business financial health. That is very important because it provides the base for computing taxes. So if your base is wrong, then you could end up paying more taxes, or you could underpay taxes. Then you could fall into challenges with the tax authority when they come and do their own assessment. Next, it also allows you to make financial projections and forecast future plans. Ultimately, bookkeeping is an essential tool for successful business management and growth. So you can only be able to make correct projections or forecast when you have a high degree of knowledge of where you are or where you're coming from. And then you can be able to look forward to the future. So, and that's why we want to emphasize that bookkeeping and accounting are important and need to be valued by entrepreneurs and business people, and and invest the necessary resources to ensure that they are able to get the reports, to get the output that is going to help them be successful and grow their enterprises. So we move on next. What are the benefits of bookkeeping? Number one, better cash flow management. Implementing good practices can help you understand where your money is going and how you can best manage it. So with bookkeeping, you are able to know, for example, that this 500,000 went to purchase inventory. This 100,000 went to purchase, was used to pay for rent. This 50,000 was used to pay for electricity, and another amount was used to buy a vehicle. So you're able to keep track and see, have a good visibility, and therefore will help you make better decisions. So this is what we call a cash flow management. keeping track of how the money is moving in. The money is coming in, so you start with money coming in from sales, and then you see other monies going out due to, for example, to investment activities, operational activities, and then other activities that could be happening in the business. The next thing is the benefit of bookkeeping is accurate financial reporting. By recording all transactions and categorizing them into different types of accounts, you can quickly and accurately access the financial information you need, such as your balance sheet, income statement, and cash flow statement. So, financial statements are the output of bookkeeping. So, bookkeeping is the backbone, is the background that enables you to produce complete and accurate financial statements. And this, you can be able to approach bankers, you can be able to approach investors with these financial statements, which are generated from the books that you have been preparing. So bookkeeping should not be looked down to, and it's important to invest to resources, that is people, equipment, and knowledge of proper bookkeeping, because poor bookkeeping is very costly in terms of the losses you can incur. Next, we can move on. Easier tax preparation. As mentioned earlier, with bookkeeping, you can keep your you can review your finances quickly and easily, saving time when it comes to filing taxes. It helps you identify potential deductions or credits that might be available to you. So the bookkeeper is able to, as they do the bookkeeping, they will be able to pick up taxes that need to be paid, such as withholding taxes, or even be able to even taxes such as value-added tax, which need to be paid. And as they prepare the books, now these books that are going to prepare are going to generate financial statements that are going to, at the end of the financial period, be used to prepare the tax computations that will be used to compute income tax. So, and therefore, bookkeeping is also the backbone or the source for tax preparation. Therefore, we can conclude that proper bookkeeping uh, results to a much easier tax preparation process. Next, we'll talk about improved business planning. By keeping track of your financial transaction, you can identify trends, forecast future cash flows, and make informed business decisions. This can involve tracking your bank accounts, invoices, other sources of income and expenses. So bookkeeping is help you do the management, the running of your business, and make decisions, observe trends, and as we talked about cash flows and other things that you can be able to pick up from the books of accounts. So that is it with the background, and now we can move into the essentials of bookkeeping records. So essential bookkeeping records, we have sales records. These track all income generated from sales. This include invoices, documents detailing sales to customers, cash register receipts, record of cash transactions, sales journal, a chronological record of sales, and credit notes. So these are important documents for a business to have and maintain properly, either in soft or hard copies, and because they will also be requested even they requested by the auditors, by the tax authorities, and other professionals that could be reviewing your books, and even your customers require this. Next, we have purchase records. This track all expenses incurred by the business. This include invoices from suppliers, documents detailing purchases from vendors. Next, we have receipts, records of cash purchases, purchase journal, a chronological record of all purchases, and finally, debit notes. Purchase journals, this is just a record of all purchases. it's important to maintain and ensure that you have a record of all purchases. A record either it could be in a system or in a book or in a physical record, but it is important that you maintain all documents of purchases as a business person, as a manager, as an employee, and it's important to file them in an orderly manner, and because all these are important for all the authority, all the professionals who interact with the books. That could be the accountants, the auditors, the tax professionals, uh, other kind of authorities that could be interested in, maybe if you are reporting to professional bodies or regulatory authorities. So next we have cash records. This track all cash inflows and outflows. This includes bank statements, deposit slips, check registers, petty cash records of small transactions. So these cash records, bank statements, it's important to maintain this, review, book, and record all transactions in the bank statements. Could be charges or deposits or payments that are in the bank, and then or even pick up any other suspicious transactions that could be happening in the bank. Next, we have deposit slips. Maybe you have cash transactions and you do deposits to the bank. Cash check registers, records of checks. Checks need to be kept safely to avoid, and so that we do not have cases of fraud. And petty cash records, which are kept in a chronological order. So it's important that we have these records are maintained in the accounting or bookkeeping process. Next, we have expense records. This record keep track of all money leaving the business. So we're talking about rent payments, utility bills, staff payments, supplier payments. So and this is not conclusive. There are so many other payments that could be there. So it's important that we keep all these records, obtain receipts, obtain invoices, and keep them, and book, enter them, and ensure all expenses are recorded so that we do not have gaps or we do not have gaps or we have other errors in the bookkeeping. Next, we have payroll records. If you have employees, you need to maintain detailed payroll records, including employee wages, tax deductions. So we have these two items here. So we could have a payroll. We could have receipts for statutories such as NHIF, SHIF, sorry. We have NSSF, we have PYE, we have and other statutories deductions, even pensions. All these records need to be maintained and booked into the book of accounts. So we have asset records. This track the value of your business assets, such as equipment, vehicles, and properties. So you need to keep records of purchases of assets in your business, and make sure that they are correctly entered, including the taxes corresponding to this. And this issue about booking taxes applies to all categories of records. We have sales records, purchase record, expense records. Then we have liability records. These are loans and accounts payable. So we need to make sure that we obtain loan statements from the banks and we are entering the booking transactions such as payments of principal and interest. We are for payables, that's accounts payables, we are booking payments to the correct creditors and or any other transactions affecting the accounts payables. Next, now we talk about popular bookkeeping terms. Popular bookkeeping terms: to effectively manage your business finances, it is essential to understand the following basic bookkeeping terms and concepts. So number one, we're going to talk about accounts payable. What is accounts payable? These are simply be defined as the money your business owes to suppliers or vendors for goods or services. This is a liability. This must be tracked and managed properly in order to maintain the financial health of a business. So, accounts payables, these are your creditors. Purchases, and if you don't make cash purchases, you pay some suppliers. You could pay them later, maybe 15 days, 10 days, 20, 30 days, 60 days, 90 days, 120 days. These are what we call accounts payable. So the monies that the business owes to suppliers or vendors of goods and services. So this is a liability. In addition, you could say is that late payments can have serious implications and result in legal and financial repercussions. So this is important to maintain correct accounts payables and note the payment terms. So if a supplier, if you have an accounting system, it could be able to track for you the days and also alert you when payments are due, and therefore you could avoid any liabilities, or maybe, for example, if there are strict suppliers who could fine you or even affect your business orders if you pay late. So it's important to track the accounts payables. So the account receivables, this can be defined as the money owed to your business by customers for goods and services. Account receivable is an asset. So accounts payable is a liability, accounts receivable is an asset. It is important to regularly review your accounts receivable to ensure that all customers are paying their bills on time. So these are your debtors, people you sell on credit. As we said, it's important to track the number of days you give them, such as same as we talked about in accounts payable, so that you can be able to collect your debtors on time. And because if you don't collect your debtors on timely, this is going to affect your cash flows. So it's important to have a proper mechanism of tracking. And if you have a sophisticated system, it can even send emails or alerts to your customers that their debt payments are coming up and they need to do what the necessary. So there are systems and technologies out there that can assist with this. Because, as I mentioned, this is important for cash flow management. Next, we have assets. These are resources owned by your business that have monetary value, such as cash, inventory, or equipment. Assets are tracked in bookkeeping to ensure proper accounting for all the items in your possessions. So these are resources owned by a business, such as accounts receivable, which you said is an asset, cash, equipment. So it's important to track these assets, these resources, because they are this important the aspect or part of your business. Each category of asset needs to be tracked, maintained correctly and completely with completeness. Next, we can move on to liabilities. These are records. These are debts owed by a business to others, such as loans or accounts payables. So loans, we have either current liabilities or non-current liabilities. Also for assets, we have current assets or non-current assets. So current assets are short-term, that is between 1 to 12 months. Non-current assets are long-term, 12 months and beyond. That applies to liabilities. Current assets, short term, that is within 12 months. Current 12 months and beyond, beyond 12 months. So they generally affect the balance sheet liabilities and must be managed carefully. Next, we move on to equity. Equity is an important concept in bookkeeping because it represents the value of the business and how much money it has in reserve. Equity is calculated by subtracting liabilities from assets. So you can define it shows you can say that equity shows how much money the company has to invest, pay debts, and invest in the business. And even I'm able to assess if it's feasible for a company to invest in a certain venture. So equity is a important concept or important part of the financial statements that needs to be tracked because you can have either positive or negative equity. Positive equity means that you have more assets. Negative equity means you have more liabilities, and it is better to have more assets. Assets, we're talking about cash, we are talking about receivables, accounts receivables, balances. So in other assets, current assets, we have some things like fixed assets and other forms of current assets. So it's important to have this than liabilities. Those are loans, accounts payables, because that means if you have more assets, that means you are able to meet your liabilities, your obligations, which are the liabilities. Next, we are going to talk about the double entry bookkeeping. This is a very important concept in accounting. Double entry bookkeeping is a booking method that records each transaction in two accounts, ensuring that debits and credits always balance. This ensures that each transaction is accurately recorded. So this is it's like a control mechanism in accounting that makes sure that each entry has a corresponding entry. So we have debits entry. We have in accounting we have a concept where we say we debit and we credit. Yeah. So for each transaction that you debit, you're supposed to also have a corresponding credit, and this makes sure so that the books of account can balance. So if you have a transaction where you are booking two debits, that there's a problem. So and that's why you'll be able, if you are keeping manual books of accounts, then and you do this, then you're going to end up with a trial balance which is not balancing. But for accounting softwares, they have a mechanism where they a control mechanism where they do not allow you to do any complete any transaction without booking the corresponding double entry. So double entry is a very key point concept for bookkeepers and accountants. So for any business person who is doing their bookkeeping, and they need to be aware about this and make sure that they follow these principles. So next we move on. So what's the importance of bookkeeping, of record keeping in bookkeeping? Record keeping is a critical part of bookkeeping. It involves keeping track of your financial transactions and organizing them in a way that makes it easy to analyze your business financial performance. In some cases, you may need to keep track of every individual transaction, while in other cases, a summary of transactions may be sufficient. It's important to keep records of in bookkeeping. So basically, bookkeeping is record keeping, and we cannot emphasize enough the need for maintaining proper books of accounts. So there are several records keeping tools that small businesses in Kenya can use to keep their financial records organized. These tools include spreadsheets. These are versatile and accessible record keeping tools that small businesses in Kenya can use. They allow you to create simple bookkeeping system by setting up columns for each column and entering transactions as they occur. Spreadsheets can use to record sales, expenses, accounts payable, accounts receivable, and other financial transactions. Excel and Google Sheets are popular spreadsheet tools that small business owners can use. So spreadsheets are are accessible, widely accessible, and are good tools that a small business can use, and are quite versatile, and you can be able to to do much with them. But they have the limitations in terms of if you have many transactions, and also the even automation. They have the automation, they have their ability to, but in terms of compared to what accounting softwares can do, they have their limitations. But spreadsheets are a good place to start, and they can be very valuable, and it's important that we highlight that that businesses can utilize this as they get started, or they get to keep the process of keeping books of accounts. So next, we go to bookkeeping softwares. Bookkeeping software, also known as accounting software, is an excellent record-keeping tool for small businesses in Kenya. It automates the process of recording financial transactions, producing financial statements, and managing other bookkeeping tasks. Bookkeeping software like QuickBooks and Zero Accounting can help small businesses in Kenya save time, reduce errors, and improve overall bookkeeping practices. So bookkeeping software have uh, automation in them, the current bookkeeping, and they are even on a cloud. So you don't even have to install applications on your machines. You subscribe on the cloud platforms for these various service providers such as QuickBooks, and you can be able to access your records, and your records will be maintained on the cloud. And this has higher capacity than the the softwares, the apps that are installed in computers. So it is important that entrepreneurs, business managers, and owners are aware and are able to utilize these softwares. We have what we call manual ledgers. These are traditional record keeping tools, physical books bought in bookshops and other places, supermarkets, is used and commonly used by small businesses. They involve manually recording financial transactions in physical ledger or journal. Although managers can be time consuming and prone to errors, they can be an affordable option for small businesses that cannot afford bookkeeping software, prefer to keep things simple. Manual ledgers are easy to understand and can help business owners keep track of their finances with minimal effort. So these are physical counter books which were used some time in the past and are still there and can be utilized by small business owners. They can be time consuming, and here we know, as you see, they are manual, so there's no automation, so they are prone to errors. So it is but for an efficient and effective bookkeeper for small enterprise, they are a good place to start. Next, we have now this way of keeping records, cloud-based storage. You can use tools such as Dropbox, Google Drive, OneDrive, an excellent way of keeping records. This saves you space on machines, and can keep records for many years. And as you know, the tax authorities, the law requires us to keep records for a number of years, and 7, even in the past 10 years. So it's important that we are able to keep our records well as bookkeeping records. So you can access them anywhere. And so we should not allow poor bookkeeping to affect the running of our business operations. So that is it for record keeping for bookkeeping. So we are going to look at essential financial statements. So financial statements are an essential component of bookkeeping, as they provide a snapshot of your business financial health. They help you to analyze your business performance, identify areas for improvement, and make informed financial decisions. So there are three financial statements small business Kenya should produce. Number one is the income statement. Number two, the balance sheet. And number four, the cash flow statement. So what is an income statement? This is also known as the profit or loss statement. It provides an overview of your business revenue, expenses, net income, or loss for a specific period. It helps you to analyze your business profitability by subtracting expenses from your revenue. You can use an income statement to identify areas where you can cut costs, increase revenue, or improve efficiency. So, an income statement is very important. This is where you're able to review your profitability. And this comes from the books of accounts, book record keeping that we mentioned from your sales, invoices, receipts, from your expenses, bills, and other records of expenses. And from this you're able records that you have maintained, then you can be able to generate a income statement. Those records feed the income statement, which is a very key component of your key component in your financial statements. So next we move on to the balance sheet. The balance sheet provides a snapshot of your business financial position at a specific point in time. The balance sheet is also called a statement of financial position. It lists your assets, your liabilities, equity, and helps determine your business net worth. A balance sheet is useful for analyzing your business liquidity, solvency, and financial health. So as I mentioned earlier, that when you have more assets than liabilities, that is a healthy position. But where you have more liabilities than assets, that's not a good position. So these are equity, as when you have positive equity, this shows a healthy business and the net worth of your business. So it shows financial analyst can be able to tell a business performance by evaluating its assets, the value of assets, the type of assets it has, the value of liabilities, and the nature of liabilities. So this important statement that a business needs to produce. Next, we have the cash flow statement. A cash flow statement provides an overview of your business cash flows, inflows and outflows for a specific period. It helps you track your business cash flow and identify areas where you need to manage your cash more effectively. A cash flow statement is useful for analyzing your business ability to generate cash, meet financial obligation, and fund its operation. So we are talking about here being able to see a positive. You can have a positive cash flow or negative cash flow. So if for example you are you can be able to see how much you're generating from your operations from the cash flow statement. You can see how much you spend in financing activities, in investing activities, even forex, the effect of forex to your cash flow. So and at the end you can see how is your business generating cash flow. Yeah. And if you have positive or negative cash flows, so it is important. And this is all these statements are produced from the records that you keep. So therefore the backbone is keeping proper records, and with proper records you'll have proper financial statements. And proper financial statements enable you to make proper analysis, proper decisions, proper focus of your business, and therefore you will do much better with maintaining all this in the right level, the correct and complete records. So next, now we are going to conclude. We have covered all the areas we needed to cover this topic. This is just to help business people employees, managers, business managers, we just reminding or emphasizing the need for businesses to keep proper book of accounts. So good bookkeeping help practices help you to understand your business financial health, make informed financial decisions, and comply with legal and tax requirements. By following the basic bookkeeping concepts and using the record keeping tools and financial statement outlined in this training, you can improve your business financial management and increase its chances of success. Remember to keep accurate and up-to-date records. Regularly review your financial statement and seek professional help when necessary. So we cannot emphasize more. We in this topic in this we have been trying to emphasize, and it's important also as we emphasize to seek professional help, and you will appreciate the need for utilizing professionals who can help you take your record keeping and accounting to the next level, and this will support your business growth. Thank you for listening through. We hope you'll be champions of proper bookkeeping and accounting. With good records, you cannot go wrong. It's the backbone of a strong business. God bless you all and see you in the next video.